Hello there everyone, today's video is all about the taxation of crypto assets. So cryptocurrencies, crypto assets, Bitcoin becoming more and more popular, dare I say more and more mainstream, certainly are accepted as a form of tender for payment in various retail establishments. Even central governments who are very nervous of them are exploring coming up with their own types of digital centralized currency. But obviously still very volatile. Look at the share price, goes up, goes down. The share price, the price of the underlying coins, the bitcoins. So what about the tax treatment? So HMRC has written a specific document on that. Because Bitcoin is evolving all the time and new strands and new things, part of the Bitcoin world, keep developing, they've had to update their guidance. They've got a whole manual now. It's just been updated as of May 2021. So they've actually got a crypto manual, which goes into full details on their thinking around this. But I just want to do a brief overview. So in a nutshell, HMRC consider that most people who are dabbling in cryptocurrencies aren't really trading from a business point of view. When people talk about we're trading in Bitcoin, they're not day traders full-time doing nothing but dealing in crypto assets, cryptocurrencies. It's more of an investment activity as opposed to a trading activity. So in the tax world, that's a big distinction. If something is a trading activity, truly trading tends to be an income tax play or corporation tax if you're a company, but assuming an individual, trading equates to income tax. If it's merely investing, even though you may think you are trading in Bitcoin because you buy and sell it on a regularly frequent basis, certainly not you're doing it as a full-time living, but nevertheless, you may deem it to be trading. Chances are it's actually investing as far as the tax man is concerned, and capital gains tax applies, not income tax. Capital gains tax at the standard rate, which is 20%, is the standard rate of capital gains tax at the moment. So let's just delve into what exactly a disposal would be. So a disposal of crypto assets could be, well, the obvious one, the first one on the list, selling crypto assets for money. So that's straightforward. That's a disposal. The other one is exchanging crypto assets for a different type of crypto assets. So if you exchange Bitcoin for Litecoin or Ether for Bitcoin, that is a disposal for capital gains tax. And the consideration is the market value of the asset that you are disposing of at the time of the disposal. Also, if you use crypto assets to pay for goods or services, like I alluded to at the top of the video, that is a disposal for capital gains tax. And also, if you give away crypto assets to another person, then that's a disposal for CGT. Again, deemed proceeds to be the market value, even though consideration is zero because you're giving them away. Taxman says, all right, forget the fact it's zero. For CGT, we're going to insert the market value at the date of the gift. So these are just some examples of what constitutes a disposal. It's not just all about, selling some crypto for cash. But of course, as with any other asset that you sell under the capital gains tax regime, there are always allowable costs that you can set off against the gain to reduce the gain and reduce the capital gains tax thereon. So, obviously, the main thing you set off is the consideration in pounds sterling of the original cost of the asset. So, you buy crypto at £100, sell it for £1,000. Well, yes, that £100 is coming off your £1,000 consideration. It's obviously a cost, so that reduces the gain. Transaction fees as well. Transactions fees, they are an allowable deduction. Any advertising, if you're advertising for a purchaser or a vendor, that comes off. Advertising costs. Professional fees, professional costs to draw up any contracts for acquisition or disposal of crypto assets, they will be allowable deductions in the CGT calculation. Indeed, the costs of making a valuation or apportionment to be able to calculate gains or losses will be deductible. So the likes of accountancy fees, people like myself, to determine what is the amount to be deducted, because I gave you a fairly simple example. You say you buy for 100 and you sell for 1,000, but it can be a lot more complicated than that. And you can get accountants, tax advisors to determine what is the actual allowable costs, and their fees are tax deductible as well. So the concept, I think most people need to get their heads around under the CGT regime, is what we call pooling. So pooling is basically where you don't identify individual assets per se. You pool them, you lump them together in a pool to determine what cost to deduct when ultimately you have a sale from part of the pool. So the easiest way to do it is to go through an example. So let's say Joe Bloggs acquires 50 tokens in a cryptocurrency. Could be Ether, Bitcoin, Litecoin, whatever it is. 50 units cost him £10,000. A few months later, he buys 50 of the same type, but the price has shot up, so it costs him £50,000. And then a few months after that, another 50 of the same type of asset class, but the cost has gone up to 100,000. So what you do, you pool these together, assets within the same type. So you have to keep all your Bitcoin separate, all your Ether separate, all your Litecoin. But assuming these three purchases the guys made are all the same type, so you just keep a record. And in the pool, after the end of those three purchases, the guy's got 150 units, 50 plus 50 plus 50, and it's cost him 160 grand. 10 plus 50 plus 100, because price has gone up. So the pool, he's got 150 units and £160,000 cost. That's what we call the pool cost. Now, what if a few months later he sells 30 of these units for £80,000? What is the capital gain? So the whole point with pooling is that it's not done on what we call a FIFO basis, first in, first out, because if it was on a FIFO basis, you'd say, well, he sold 30. Let's assume, the cost will be 30. We'll take it from the first tranche that he bought when he only spent £10,000, and he bought 50 of those. So the cost will be under £10,000. That's not what you do. It's not on a FIFO basis. It's on a pool basis. So what we say is, look, the cost, you apportion the pool, and he sold 30. He had 150, but his cost was 160,000. So the cost of what he's disposed of is just simply 30 divided by 150 times the £160,000 pool cost, which is a £32,000 cost. So that gives a better result on that initial disposal than as if he'd done it on the FIFO basis. The FIFO basis would have given him a much smaller deduction on the cost base. So basically, sold the 30 units for £80,000, but can deduct £32,000 as a cost, being this pooled calculation of 30 units sold on a pool of 150 multiplied by the total pool cost. And it's that sort of thing where accountants and tax advisors step in and get involved, although there's no reason really why anyone can't do that themselves, but it can get a little bit tricky. And again, those professional fees would be tax deductible to add on to the determined cost from that pool in the calculation. So pooling is something that I think most people who are dabbling in crypto, and when it comes to tax, they will have to get their heads around the concept of the pooling to work out the capital gain. Now, there are, again, enhancements to this, little bit more complex rules if you then reacquire the same asset class on the same day. So in this case, the guy sold 30, but what if he bought back 10 just a few hours later? Special rules for that. And also, if you buy back within 30 days, again, there are special rules. So I would urge you to keep detailed records, basically of all your transactions on crypto, the date you bought them, how many units did you buy, what was the type of asset, how much did you pay for it. Keep a log, and again for the disposals as well, exactly how many units were disposed of, what was the consideration, in other words, how much did you get for them, and the dates, and then that can all be passed to accountants, tax advisors to crunch the numbers and determine the capital gains tax. Now, where things get a little bit more complicated is if you are not doing what most people are doing, which is investing, even though you may consider it to be trading, is genuine trading for those people who are spending full time as crypto traders. Now, for those people, then it is an income tax play, not a capital gains tax play. And then, of course, income tax, as we know, subject to higher rates, potentially 45% income tax on gains, which in tax jargon, there wouldn't be capital gains, there would be profit on trading. So you buy and sell your crypto assets, and it's the profits that you make on the trades would be subject to the income tax. So things like mining, if you're getting involved in mining, or even staking, all these various new things that are only really being developed all the time, and there's new ways to make money on crypto happening all the time. Even interest-bearing crypto deposit accounts, again, the interest or the deemed interest, that would be subject to income tax as opposed to capital gains tax. So quite a bit to think about. I think the vast majority of people, though, would just have to think about capital gains tax when they are selling crypto assets. But as I said, it could be that if you're getting involved in some of these more esoteric areas, that income tax does come into play. But I would advise you as well just to Google HMRC's crypto manual, because in terms of the best source reference of the taxation of crypto assets, there is nowhere better than HMRC's own manual. That has the full chapter on verse on every possible scenario. Well, they're coming up with new ones all the time, of course, but currently known to the public, to HMRC, to the authorities, and as I said, it's an evolving feast. It really is. A lot of talk in the US and in China of transactions in value in excess of a certain amount being automatically reported to the authorities, because the tax authorities, particularly in China and America, are worried that people aren't disclosing these gains, these trades, these profits. It's all very well having the rules in place, but when they're not disclosing them, then obviously there's a problem. So that in America, they're talking about having some sort of mechanism where the IRS, which is the tax authorities over there, are automatically informed of any transactions over a certain amount, rather than waiting to put it on a tax return like you would do in the UK. Because let's say right now you had one of these disposals on your Bitcoin in the UK and there was potential capital gain. Well, that would go on your 21-22 tax return, and any tax wouldn't be due until January 2023. So the authorities in the States are saying they want to find out about this a lot sooner, and that could be the way it goes over here as well. It could be, even though the tax at the moment is payable at the end of the 9 months after the end of the fiscal year it relates to. It could be that it changes to be a lot sooner, a bit like how capital gains tax has recently changed on residential property. When you sell your buy-to-let properties, you have to pay capital gains tax within 30 days now, where it used to be up to 22 months. So again, that could come in for crypto. At the minute, it hasn't, but bearing in mind with the way the world is going, it may well do. So all this uncertainty on different sovereign nations taxing crypto, or in terms of wanting information on it, made the share price go down about 5% just a few days ago. But like I said, it is quite a volatile. It goes up and down all the time. Yes, becoming more mainstream doesn't mean it's going to be a safer investment, but it's certainly a lot more people are getting involved. Hence why the tax authorities are taking such an interest. Our own HMRC here, even like I said, put together this whole manual on crypto assets, how to tax how to tax them. So they are getting a lot more spotlight focused on them. But yeah, if you are certainly a UK resident dabbling in a bit of Bitcoin or Ether or any of the others, then potentially, like I said, capital gains tax will apply, and you really need to have a look at the pooling rules. But the tip for the day is keep detailed logs of all your purchases and all your sales. So if you like this video, please do subscribe right there, and I will see you soon.